You've known for 3 days that this position is a loser. The setup that got you in is gone. The reason you bought it doesn't apply anymore, and it's still open. If someone handed you cash right now and asked, would you open this exact position today, you'd say no without even thinking about it. So why is closing it so much harder than opening a brand new one would be? The usual explanation is that you're bad at admitting when you're wrong, but that's not quite it either, because you probably admit you're wrong about plenty of other things without much trouble. You'll happily change your mind about a restaurant, a movie, a hiring decision. There's something specific about a losing position that makes closing it feel fundamentally different from every other decision you make, and psychologists have actually isolated what that something is. Start with a classic study from psychologist Hal Arkus working with Catherine Bloomer on what's now called the sunk cost effect. In one of their experiments, people were told they'd already spent $100 on a non-refundable ski trip, then discovered a better trip for $50, but the tickets couldn't both be used. Logically, the money already spent shouldn't factor into which trip to take at all. It's gone either way. But participants overwhelmingly chose the worse, more expensive trip specifically because they'd already paid for it. Arkus and Bloomer's research found this pattern everywhere they looked. People escalate commitment to something specifically because of what they've already invested in it, even when they're told outright that shouldn't matter, and even when doing so guarantees a worse outcome. Sit with what that means for a losing trade. The money you're down on that position isn't actually yours to protect in any meaningful sense. It already happened. It's already gone whether you close the trade or not. But it doesn't feel that way. It feels like closing the position is the moment you actually lose the money, rather than the moment you simply admit you already lost it. Arkus and Bloomer's research says that feeling is a well-documented cognitive bias, not a personal flaw, and it's strong enough to make smart, rational people choose worse outcomes just to avoid declaring an earlier decision a mistake. What made their research especially convincing is that the effect held up even when people were explicitly warned about it beforehand. Simply knowing about the sunk cost effect didn't make participants immune to it. They'd still throw good money after bad, still chase the trip they'd already have paid for, even while being able to correctly explain, if asked, why that was the wrong call. That detail matters a lot for trading, because it means you can know everything in this video, be able to recite the sunk cost effect back perfectly, and still feel the exact same pull to hold the loser one more day. Awareness alone was never going to be the fix in Arkus's data or in your trading account. There's a specific version of this that shows up constantly in position sizing too. A trader who wouldn't dream of opening a full-size position on a setup that's already broken down will often let an existing full-size position ride well past that same point, purely because it's already open. The size of the position is identical in both scenarios. The only thing that's changed is whether the money has already been committed, and Arkus's research says that single detail is enough to flip the decision. Here's a question worth asking yourself honestly. When you're holding a loser, are you actually still evaluating the trade, or are you just trying to avoid admitting the money is already gone? If this is putting language to something you've felt but never quite named, this is a good point to hit like and subscribe, because the next piece explains why closing a loss feels worse in the moment than it ever will feel in hindsight, and why that gap is exactly what keeps you holding. That brings in a second researcher, Thomas Gilovich, who has spent decades studying regret, specifically the difference between regretting things you did and regretting things you didn't. Gilovich's research found a consistent pattern across life decisions. In the short term, people regret their actions more sharply than their inactions, even when the inaction caused more damage. But over a longer hindsight horizon, that flips. Inaction regret grows and lingers, while action regret tends to fade faster, because at least you know you tried. Apply that directly to the moment you're staring at a red position. Closing it is an action. It's a decision you have to actively make, click, confirm, and live with immediately. Continuing to hold it doesn't feel like a decision at all. It feels like nothing, like the absence of a choice. Gilovich's research explains why that feels so different. In the short term, your brain weighs the sharp, immediate regret of an action, I closed it and then it bounced back, far more heavily than the slow-building regret of inaction, I held it and it kept bleeding. Even though the second one is usually far more expensive, it simply doesn't register the same way in the moment the decision needs to be made. Gilovich's follow-up work dug into why this asymmetry exists at all, and it comes down to how the brain handles blame. An action gives you a single, clear moment to point to and say, "That's where I went wrong," which makes the regret feel sharper, but also more contained, more finished. Inaction doesn't give you that moment. There's no single click to blame, just a long stretch of not deciding, which means the regret never really resolves. It just keeps quietly accumulating in the background. That's part of why traders can hold a losing position for weeks without a single moment that feels like the mistake, even though added up, it's usually the single most expensive non-decision in their entire account. This is the counterintuitive part, and it's worth sitting with. Trying to feel less regret in the moment doesn't actually fix this, because the asymmetry isn't a mood, it's built into how the decision is structured. The real fix, based on both Arcus's and Gilovich's findings, is removing the decision from that moment entirely. A stop loss you set the instant you enter a trade, before any money is either invested in Arcus's sense or emotionally attached in Gilovich's sense, isn't a live decision you have to make under the exact conditions engineered to produce the worst possible judgment. It's a decision you already made back when your head was clear, simply being carried out. You're not choosing to lose anything in that moment. You already decided, calmly, in advance, exactly what losing would look like and exactly when you'd accept it. Even journaling the trade the instant you enter it helps more than it sounds like it should. Writing down in that instant exactly what would prove the idea wrong gives future you something concrete to check the position against later, instead of a vague, shifting sense of it might still work out. That single sentence, written before any money is on the line, does more to counter both Arcus's sunk cost pull and Gilovich's regret asymmetry than any amount of willpower applied after the position's already gone red. You can see the same two mechanisms running side by side in plenty of places that have nothing to do with markets. People stay in renovation projects that have already cost twice the original budget because stopping now would mean wasting everything already spent, which is Arcus's sunk cost effect in a different outfit. People stay in situations, jobs, relationships, subscriptions, long after they know it's the wrong call, because ending it is an action that produces sharp, immediate regret, while staying produces the slower, quieter kind that Gilovich found people underweight in the moment. Even a half-finished book that isn't going anywhere gets carried to the last page by plenty of otherwise decisive people for the exact same reason a losing trade gets carried past the point it should have been closed. A losing trade just compresses both of those forces into a single flashing number on a screen, updating in real time with nowhere to look away. So the next time you notice yourself holding a position days past the point you'd open it fresh, the honest question isn't, am I sure this will turn around? It's, am I protecting an outcome, or am I just trying to avoid admitting the money is already gone? Those are two completely different problems, and only one of them has anything to do with the market at all. That original position is still open, or it isn't by the time you're watching this. Either way, the real test was never whether you could pick winners. It was whether you'd already decided, back when your head was clear, exactly what losing would look like, so future you never had to make that call while staring at the number. If this changed how you think about the loser you're still holding, tell us in the comments how long you've been in it and what you think is actually keeping you there. Hit like and subscribe for more of this. Thanks for watching.